Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Confidence has been steadily building around the idea of a US rate cut cycle, with the yield curve beginning to uninvert as short term yields drop. While this uninversion signals that a series of cuts are priced in, it's not necessarily a positive indicator. It could also point to the onset of a potential recession. Yesterday, JOLTS data further strengthened the case of a rate cut in September, aligning with the broader sentiment in the market. Good morning, JK. If the job market continues to show weakness this week and the unemployment rate rises sharply, do you think the possibility of a 50 basis point cut could also come back to the table?
Good morning, sir. Yes, I think Friday's data will be very important. I see if rate even goes to 4.5% on the unemployment, chances of 50 basis point cut definitely increases, and I feel the Fed might actually do that. If you look at the language of Powell, also last Jackson Hole speech, it was very clear that the focus was going to be on having a strong jobs market and shift away from inflation. So there was, of course, a relief for the markets when the US JOLTS data was announced yesterday. That's because markets have discounted a weak number and rate cuts to such an extent that a strong number would have actually resulted in huge short covering in the dollar, as well as some sort of a reversal in the bond markets. But job opening actually fell much more than expected at 7.67 from 7.91 million in June. Expectation was for 8.1 million. The data also shows that now there are only 1.1 jobs available for every person looking for job, which actually peaked at 2.03 in March 2022. And it has not been this slim for several years. Layoffs and discharges also spiked in July to 1.76 million, the highest since the spring of this year. So this was enough for the market to actually bring up the expectation, or rather the probabilities of 50 basis points cut to 45% probability now. Of course, 25 basis points is almost given. In this background, even the factory orders, which came higher than expected at 5% than 4.7%, was actually ignored by the market. On the contrary, the Fed Beach Book reported growth continuing to soften in many states. Nine of the districts rather reported flat or declining level of activity, while only 3 reported improvement. So this is data that's very key source of analysis for the FOMC or staff at their September 18 decision as well. Now, to answer your question, I think we have a good chance of a 50 basis points cut on September 18th if the jobless rate goes up. There was some relief from Eurozone data yesterday, as the services activity expanded at the strongest pace since May of this year, and it was driven by a quicker upturn in the services activity. Although this also marked the 6th consecutive month of growth, but there was some fragility across the new orders and employment as well. But the strongest number, of course, came from UK. Headline actually showing a big rise at 53.7, up from 52.5, and so well into the expansion zone. China continued to show fall in the activity level. Services index falling to 51.6 from 52.1 in the previous month. So the data from other regions are quite mixed, and US is weakening. So you can see the overall activity levels globally is somewhat on the weaker side. I would say barring a few economies like UK and Japan, where it is improving, makes a case for bond market to really be on the front foot. Yields are really showing that actually. Yesterday, the 2-year yield fell by nearly 13 basis points, while 10-year yield fell by 9 basis points. Now they are at a crucial support of 3.75%. And yes, you also mentioned about the uninversion of the yield curve. Now, inversion of the yield curve is also associated with the fears of recession going forward, but uninversion is now being read as a possibility of a hard landing for the economy, which means there will be near-term rate cut. The near-term rates will fall. So that is the market's interpretation now. Yes, speaking of rate cuts, the Bank of Canada cut a policy rate by 0.25% to 4.25% yesterday. This is the third move, and they also are hinting at more moves to come as the inflation keeps coming lower. Yes, the job market, job data did help yields come lower, but the stock market did not take much here. In fact, particularly Nasdaq and S&P 500 were negative, small of course, but importantly, the rate cut expectations, or perhaps even the actual rate cut, may not lead to a big stock rally, because that seems to be coming on the back of a sharply slowing economy. Sharply slowing economy does mean that companies' performances might also be on the lower side. So that's why the stocks are not gaining. It's a bond market, and perhaps gold going forward, because gold has consolidated quite a bit around 2,500 levels, and looks like it can make more gains in the coming days. So the currency side, we had yen making the maximum gain of 1.25%, obviously, because Fed rate cuts coupled with the probabilities of yen rate hike helps the yen to a great extent. Other currencies also gained, but not as much as yen, because these currencies were bought against the dollar, but they were sold against the yen because yen was getting much stronger. The other reason why the stocks did not perform much was also because yen strength led some people to do more carry unwind. So we have a situation where rate cuts are on the anvil, but it may not really help the stock market so much. And in the currencies, yen is likely to gain much more in the coming days. Of course, speaking of the currencies, the rupee hit a new all-time high yesterday, exceeding the previous high by just 0.75 paisa. But that it's a that does not signal a new up move for the rupee. It only indicates that there was enough demand to take it there. After which actually RBI action was dominant, selling consistently. Curiously, more buying was seen from PSU banks, which probably indicates some sort of a PSU outflows that was being actually met with the central bank sales. Even onshore market, after the data showing lower job openings, did not help the rupee to move much away from 83.96 levels. Finally, there has been a lot of commodity meltdown in the recent days, expectation of economies weakening. Yesterday, of course, OPEC was trying to salvage some of the big slide in the oil prices, and they were considering postponing the scheduled increase in output, which was to start in October, and that can probably give some support to the oil prices. But definitely, market is trying to assess how the demand is going forward. Thank you.
Thank you, JK. And of course, as we have been discussing for many weeks, especially after the Jackson Hole, focus for the Fed is on the jobs market. So jobs market data this week is very, very crucial. Now, JOLTS, which was the first series of data being released, JOLTS data felt quite a bit coming in below expectations. Layoffs and discharges also shot up in July. This is crucial because this has brought up the probability of a 50 basis cut in September to 45%. And even a strong factory orders number from the US was ignored by the market. So all of this is playing out this particular theme, ongoing rate cuts, and of course, overall there will be repricing. Maybe the markets sometimes price too many rate cuts as opposed to what will happen, and all sorts of adjustments happen. But of course, because of this, uninversion of yield curve is now being read as a hard landing by the market. So the series of cuts remain priced in displays that the underlying economy is weak, which is not good news for the stocks as well. For rupee, we hit new all-time lows against the dollar. And as JK mentioned, more dollar buying was seen by the PSU banks due to some outflows. That's it from us today. Thank you for listening. Tune in tomorrow for the latest in the financial markets.